Have you ever looked at the cryptocurrency market and thought, man, if only I had more capital to play with, I could really amplify my gains? If so, you're not alone. The allure of turning small movements into significant profits is a powerful one, and it's a driving force behind a concept known as margin trading. But what exactly is margin trading, especially in the context of a major exchange like Kraken? And more importantly, is it a golden ticket to riches or a fast track to liquidation? Today, we're diving deep into the world of Kraken margin trading. We'll demystify the jargon, break down the mechanics, and explore both the incredible opportunities and the considerable risks involved. This isn't just a theoretical discussion. We're going to give you a comprehensive understanding so you can decide if this advanced trading strategy is right for your portfolio. So, buckle up, because by the end of this video, you'll have a clear picture of what it means to trade on margin on Kraken. Let's start with the fundamental concept, leverage. Imagine you have $100. If you buy a cryptocurrency that goes up 10%, you make $10. Simple, right? Now, imagine if you could use that same $100 to control $500 worth of that cryptocurrency. If it still goes up 10%, your profit is now $50, 5 times what it would have been. That's the power of leverage. In essence, margin trading allows you to borrow funds from the exchange to increase your exposure to a particular asset. The margin is the collateral you put up to secure that loan. Kraken, being one of the oldest and most respected cryptocurrency exchanges, offers margin trading for a variety of digital assets. They act as the lender, providing you with the additional capital you need to open larger positions than your own funds would allow. This isn't charity, of course. Kraken charges interest on these borrowed funds, and we'll get into those details later. Now, let's break down the core components of Kraken margin trading. First, you have your initial margin. This is the minimum amount of your own funds you need to deposit into your margin account to open a leveraged position. Think of it as a down payment. Kraken specifies different initial margin requirements for various trading pairs, typically expressed as a percentage of the total position value. For instance, if the initial margin requirement is 20% and you want to open a $1,000 position, you'd need to put up $200 of your own capital. Next comes maintenance margin. This is crucial. Once your position is open, the market can move against you. If the value of your position drops and your equity, your initial margin plus or minus any profits or losses, falls below a certain threshold, that's your maintenance margin. This acts as a safety net for Kraken. If your equity dips below this level, you'll receive a margin call. A margin call is a polite, or not so polite, depending on your perspective, request from Kraken to deposit more funds into your margin account. The goal is to bring your equity back above the maintenance margin level. If you fail to meet a margin call, that's when things get serious. Failure to meet a margin call leads to liquidation. This is the point where Kraken automatically closes your position to prevent further losses for both you and the exchange. It's an automatic process designed to protect the exchange from bad debt. When liquidated, you lose your initial margin and potentially more, depending on the severity of the market move. This is arguably the biggest risk of margin trading, the possibility of losing your entire investment, and sometimes even more than your initial margin, if the market moves drastically and quickly. Kraken offers different levels of leverage, allowing you to choose how much you want to amplify your potential gains and losses. Common leverage options might include 2x, 3x, or even 5x. A 5x leverage means for every $1 of your own capital, you can control $5 worth of an asset. While higher leverage can lead to bigger profits, it also dramatically increases your risk of liquidation. A small price swing against your position can wipe out your entire margin with high leverage. So, how do you actually engage in margin trading on Kraken? It's a fairly straightforward process once you understand the concepts. First, you'll need a verified Kraken account. Then, you'll need to enable margin trading in your account settings. This usually involves acknowledging the risks and agreeing to Kraken's terms of service for margin trading. Once enabled, you'll typically transfer funds from your spot wallet to your margin wallet. This is where your collateral for leveraged positions will reside. When you're ready to open a margin trade, you'll select the desired trading pair, e.g., BTC/USD, choose margin instead of spot trading, and then specify the amount you want to trade and your desired leverage. Kraken will then show you the required initial margin. You can open both long and short positions on margin. A long position on margin means you're borrowing funds to buy an asset, betting that its price will go up. If the price rises, you sell the asset, repay the borrowed funds, plus interest, and pocket the difference. A short position on margin is where things get really interesting. Here, you're borrowing an asset, say, Bitcoin, from Kraken, selling it immediately on the open market, and betting that its price will go down. If the price drops, you then buy back the same amount of Bitcoin at a lower price, return it to Kraken, plus interest, and keep the profit from the price difference. Shorting allows you to profit from declining markets, a capability not available with standard spot trading. Of course, using Kraken's borrowed funds isn't free. Kraken charges funding fees or rollover fees on your open margin positions. These fees are typically calculated periodically, e.g., every 4 hours, and are a percentage of the borrowed amount. The exact rates can vary depending on the asset and market conditions, so it's essential to check Kraken's fee schedule. These fees, while seemingly small individually, can add up significantly over time, especially for long-held positions. This is why margin trading is often more suited for short to medium-term strategies rather than long-term holding. Before you jump in, let's talk about the absolute necessities for successful Kraken margin trading. First and foremost, risk management. This cannot be stressed enough. Never, ever, trade with more than you can afford to lose. And even then, allocate only a small percentage of your total portfolio to margin trading. Because of the amplified losses, even a small, unexpected market swing can be devastating. Implement stop-loss orders. A stop-loss order automatically closes your position when the price of the asset reaches a predetermined level, limiting your potential losses. This is your most important tool in preventing liquidation. Setting a stop-loss is non-negotiable for anyone serious about margin trading. Understand liquidation prices. Kraken will show you an estimated liquidation price for your position based on your leverage and current market price. Always be aware of this price and use it to inform your risk management strategy. Have a clear trading plan. Don't just trade on a whim. Define your entry and exit points, your profit targets, and your maximum acceptable loss before you open a position. Stick to your plan rigorously. Emotional trading is a fast path to losses. With that said, thanks for watching and until next time.